Hello and welcome back to my channel, TradingProbability.com. Today we're going to be looking at which markets you should trade. Please take a minute to look at the disclaimer at the bottom of this page. When you first start trading or investing, you may be overwhelmed by how many markets there are to choose from. Here are my top tips for deciding which pairs to add to your watch list. First, let's start by looking at the markets that I trade. You can see that I trade the $7 majors, a range of minors and crosses. I trade 3 commodities, gold, silver and oil. I also trade 3 indices, the S&P 500, the FTSE 100 and the DAX 30. So here's what I think you should look for when deciding which markets to trade. The first thing to look for is the spread. The spread should be relatively low compared to the overall range of the pair. So here we have an example, the Euro USD has roughly a 0.6 pip spread, depending on which broker you use. Its ATR is around 106 pips. So as we can see, the spread is around 0.5% of the daily range. Now the daily range is how much the pair moves on a daily basis on average. If you're swing trading, hopefully the spread won't eat into your bottom line. 0.5% is probably the lowest you're going to get. As a rule, you definitely don't want the spread more than 5% of the daily range, and I would never ever take a trade with a spread more than 10% of the daily range. But in forex in general, the spreads are pretty low, and you won't often find spreads that are ridiculously high. It's only if you venture into different markets like commodities, stocks, indices, you're going to start finding that spreads can get quite high, especially the individual stocks. The second element to look for when choosing which market to trade is the general price action of the market. Some forex pairs in general have choppier price action than others. Obviously this is strategy dependent, but I'm assuming that most people won't want to trade the choppier markets. And what I mean by choppy is the market ranges around a lot, the moves aren't very clean, and there's just a lot of overlap. Now let's have a look at an example of the Euro USD versus the Euro Swiss. This is a chart of the Euro USD, and as we can see, the moves are pretty clean. There's not much overlap, it's not very choppy, you can kind of tell what's going on. But then if we compare this to a chart of the Euro Swiss, there's so much overlap. Every candle is overlapping with the candle before it, more or less. You can't really see what's going on, you can't get a clear read, and most importantly, it makes it even more difficult to place a stop. The third thing to look for is correlation. Taking Euro USD and Dollar Swiss as an example, they're very inversely correlated. They've got a minus 92% correlation. So if you get a long trade opportunity in Euro USD and you also see a short trade in Dollar Swiss, you're effectively taking exactly the same trade because the markets are mirror images. Obviously you don't want to be long one, short the other, because you're doubling your risk, which is very dangerous. If they both lose, you've lost double what you originally intended to, even though you've only been wrong technically on one trade idea. That's why I always recommend checking the correlations before you enter more than one trade. Obviously you can look at Euro USD and Dollar Swiss, but just make sure you don't take a trade in both at the same time. So that brings me to the end of this short video on which markets to trade. Hope you found it useful. Don't forget to check out the blog at TradingProbability.com. If you have any questions, leave them down below, and I'll catch you in the next video.